Okay, so the big question is why rent when I can just go and take out a mortgage and basically pay the same out-of-pocket cost per month? Shouldn't I just buy a house instead? Because if I'm renting one, the money just goes to the landlord, and if I'm buying one, well, I gain equity within the house. We're going to jump into all that today. It's going to be a short little video on this, although I'm just warning you now, this is an oversimplification of all of this, and it's just a rule of thumb, basically. A lot of people look at the out-of-pocket cost per month. Just because buying a home or the mortgage payment per month is $2,000, and let's say renting is $2,000, that is not comparing apples to apples, because you're not looking at other variables that can affect the overall cost of renting versus owning. Now, how can we take these apples and oranges and put them on the same level to compare them? Well, we have to look at the unrecoverable costs to renting and to owning. To renting is very simple. When you give away that payment, that is an unrecoverable cost. It is a service that you are buying to live in that apartment or condo, and you will not be able to regain that equity or cash back in the future. There's many more variables to a mortgage payment than a rental payment, such as the insurance, the interest on the principal, and of course unrecoverable costs that you won't actually see firsthand until you actually own the property. A lot of people like to go by the 5% rule, which I'll be breaking down today. The 5% rule is basically showing how there's unrecoverable costs to owning and unrecoverable costs to renting, although the 5% rule basically puts it on the same level. Now, one cost out of pocket that a lot of people don't realize or take into account in is renting or buying, which one's out of pocket, is the property maintenance. Now, this can be large things like redoing a roof or redoing an entire kitchen, or small things like replacing a faucet or doing different caulking in the bathroom. Now, a rule of thumb is that's going to be about 1% of the value of the home per year. So if you have a $300,000 home, it will be about $3,000 just to maintain that property throughout the year. Moving on to the second pillar, and that is property taxes. Property taxes are very expensive. Let's just say they're approximately 1%. So again, just for owning that property, you're going to have to pay out of pocket every single year, depending upon where you live. I'm just going to say 1% because that's basically the average of overall in the United States. Now, the biggest factor in this is the cost of capital. Now, when you go and take a loan for, let's say, 80% of the value of the home, you are going to have to pay interest on that principal that you borrowed. Right now, it's about 3%. And I'm going to get into why 3% is a very good rate to use in this current market. Now, this goes with opportunity cost. If you put 20% down on a house, that means that you're putting that cash into that asset, and you won't be able to allocate those funds towards stocks or alternative investments as well. Throughout history, globally, I'm not just speaking about the United States stock market and the United States real estate market. I'm talking about a global economy here. Stocks have returned about a 3% higher return than real estate. Now, if you take over the last 200 years, real estate has gone up approximately about 1.8, 1.9%, let's just say 2%. And then again, with inflation, that would be another about 1.7%. So we're looking somewhere in the realm of like 3.5%. While stocks have been able to return approximately a 6.5% return, which is about 3% difference. So no matter which way you go in purchasing your house, there is a cost of that capital, and that is going to be an unrecoverable cost to owning that property. Now, if you've kept up, that's 1% for property taxes, 1% for maintenance, and 3% for cost of capital, equating to 5%, hence the 5% rule. Now, when taking that 5% rule, we need to implement that into our rental payment so we can compare apples to apples. So if you take the home value, multiply it by 5%, and then divide that over 12 months, that will give you what basically your baseline is for buying a property. Let's say you're renting a place for $3,000 per month, which should be a pretty nice place. You're going to multiply that by the 12 months out of the year and then divide by the 5%, hence leveling the playing field of the 5% of owning the property. And it's, again, not this simple because I'm basically writing off a lot of things such as like taxes and stuff like that. Although, again, this is just a rule of thumb, and it should get you thinking about renting versus owning, because renting versus owning, there's a lot more to it than just what am I paying out of pocket per month. Now, going off on a little side tangent on economics, basically, if the rent is higher than the mortgage property payment per month, that is not going to last very long. Yes, it might last 2, 3, 4, 6, 8 months, although it eventually will subside because there will be investors going to gobble up those investment properties because they are going to be able to cash flow. It's a very hot market. Investors are going to just devour all those properties and make them into rental properties because why not? That slight arbitrage will not last very long, and if you're looking for the next 5, 10, 15, 30 years, that is not going to be sustainable because that's just the short-term view. You need to be looking at the longer-term view if you're looking to own a property. So now, if this helped open your eyes on renting versus owning, I would really appreciate if you could just smash that like button. It really helps out me and the channel, and of course subscribe so you can keep up with all the uploads that I upload. Until then, good luck in the markets, and see you next time.